Want to feel more confident about your stock picks? You're not alone. Many new investors find the stock market intimidating. But guess what? There's a secret weapon that can help: technical analysis. Technical analysis is like being a detective for stocks. It helps you understand past market movements. This can help you make smarter guesses about where prices might go next. The best part? You don't need to be a math whiz to use it. Think of it like this. Imagine trying to predict the weather without looking at any forecasts. You might get lucky sometimes, but you'll probably get rained on a lot. Technical analysis is your stock market forecast. It helps you make more informed decisions. So are you ready to unlock the market secrets? Let's dive in. Before you can become a stock detective, you need to learn the language of charts. This is the foundation upon which all your future analysis will be built. Charts are visual representations of a stock's price history. They paint a picture of how the stock has performed over time, allowing you to see patterns and trends that might not be obvious from just looking at numbers. There are three main types of charts that you'll encounter in your journey: line charts, bar charts, and candlestick charts. Each type of chart has its own unique way of presenting data, and understanding these differences is crucial. Line charts are the simplest form of chart. They connect closing prices with a single line, making it easy to see the overall direction of the stock over time. This simplicity makes them a great starting point for beginners. Bar charts provide more detail than line charts. They show the opening, high, low, and closing prices for each period, giving you a more comprehensive view of the stock's performance. This additional information can be invaluable for making more informed decisions. Candlestick charts are my favorite. They look like, you guessed it, candlesticks. Each candle tells a story about the trading day, showing the price range and whether the stock closed higher or lower than it opened. This visual representation can help you quickly grasp the market sentiment. Don't worry if you feel overwhelmed by all this information. You don't need to be a charting expert right away. Start with one type of chart and get comfortable with it before moving on to others. This step-by-step approach will make the learning process more manageable and less intimidating. As you become more familiar with each type of chart, you'll start to notice patterns and trends that can help you make better trading decisions. For example, you might see a stock consistently hitting higher highs and higher lows, indicating an upward trend. Or you might notice a stock forming a pattern known as a head and shoulders, which can signal a potential reversal in the stock's direction. These patterns are like clues that can help you predict future price movements. The more you practice reading charts, the more intuitive it will become. Over time, you'll develop your own style and preferences, and you'll be able to quickly identify the most important information at a glance. Remember, every great stock detective started where you are now. With patience and practice, you'll be able to decipher the language of charts and use this powerful tool to your advantage. So, take your time, study each type of chart, and don't be afraid to make mistakes. Each misstep is a learning opportunity that will bring you one step closer to mastering the art of chart analysis. Happy charting, and may your journey into the world of stock analysis be both enlightening and profitable, showing the price range and whether the stock closed higher or lower than it opened. Don't worry if you feel overwhelmed. You don't need to be a charting expert right away. Start with one type of chart and get comfortable with it before moving on to others. One of the most important things technical analysis helps you identify is market trends. A trend simply shows you the general direction a stock price is moving. Think of it like riding a wave. An uptrend means the stock price is generally moving upwards. It's like catching a wave and riding it to the shore. A downtrend means the price is moving downwards. It's best to avoid these waves unless you're short selling. Then there are sideways trends. These happen when prices move within a defined range. It's like the water is calm with no waves in sight. Recognizing these trends can help you decide when to buy, sell, or simply stay out of the market. Now let's talk about support and resistance levels. Think of these as the floor and ceiling of a stock's price movement. Support is like a safety net. It's the price level where buying interest has historically been strong enough to prevent the price from dropping further. Resistance is the opposite. It's like a ceiling that's hard to break through. It's a price level where selling pressure has historically been strong enough to prevent the price from rising further. Understanding support and resistance levels can help you make smarter trading decisions. You can buy near support levels and aim to sell as the price approaches resistance. Section 5. Navigating with technical indicators. Technical indicators are like tools in your stock detective kit. They help you analyze price charts and identify potential trading opportunities. There are tons of indicators out there, but don't worry, you don't need to learn them all. Some popular indicators for beginners include moving averages, the relative strength index, or RSI, and the moving average convergence divergence, also known as MACD. These indicators can help you spot trends, understand price momentum, and even anticipate potential trend reversals. Think of them like your trusty compass, map, and binoculars, guiding you through the market terrain. Remember, each indicator tells a different part of the story. It's best to combine them with other analysis techniques. Section 6. Mastering moving averages for smoother trading. Moving averages are one of the simplest yet most effective technical indicators. They are widely used by traders and investors to help make sense of market trends and price movements. By smoothing out the noise of daily price fluctuations, moving averages provide a clearer view of the market's direction. They help smooth out price fluctuations and highlight the underlying trend. This makes it easier to identify the overall direction of a stock or market, whether it's trending upwards, downwards, or moving sideways. By focusing on the trend, traders can make more informed decisions and avoid getting caught up in short-term volatility. Think of it like looking at a map instead of navigating through a dense forest. Just as a map provides a clear overview of the terrain, moving averages offer a simplified view of price movements, helping traders to see the bigger picture and plan their trades accordingly. A simple moving average, or SMA, is calculated by averaging a stock's closing prices over a specific period. This period can vary depending on the trader's strategy and the time frame they are analyzing. Common periods include 10, 20, 50, and 200 days. For example, a 20-day SMA averages the last 20 closing prices. This creates a smooth line that helps to filter out the daily price noise and reveals the underlying trend. The longer the period, the smoother the moving average will be. This helps you see the bigger picture without getting bogged down by daily price swings. Long-term moving averages, such as the 200-day SMA, are particularly useful for identifying major trends and potential reversal points. You can use moving averages to identify buy and sell signals. When combined with other technical indicators, moving averages can provide powerful insights into market behavior and help traders to time their entries and exits more effectively. When the price crosses above a moving average, it can signal a potential buy opportunity. This is often seen as a bullish signal, indicating that the stock may be starting a new upward trend. Conversely, when the price crosses below a moving average, it can signal a potential sell opportunity. This bearish signal suggests that the stock may be entering a downtrend, and traders might consider selling or shorting the stock to capitalize on the decline. Section 7. Gauging momentum with the RSI. The Relative Strength Index, or RSI, is another handy indicator that measures the strength and momentum of price movements. It tells you how quickly and dramatically a stock's price is moving. Think of it like a speedometer for stocks. A high RSI reading above 70 suggests the stock might be overbought. This means it's gone up too fast and could be due for a pullback. A low RSI reading below 30 suggests the stock might be oversold. This means it's dropped too fast and could be due for a bounce. However, remember that the RSI is just one indicator. Don't rely on it solely for making trading decisions. Section 8. Identifying trend reversals with the MACD. The Moving Average Convergence Divergence, or MACD, is a versatile indicator that can help you identify potential trend reversals. It is widely used by traders and analysts to understand market momentum and predict future price movements. By analyzing the relationship between two moving averages of a stock's price, the MACD provides insights that are crucial for making informed trading decisions. It does this by comparing two moving averages of a stock's price. Typically, these are the 12-day and 26-day exponential moving averages, EMAs. The difference between these two EMAs forms the MACD line, which is then plotted against a 9-day EMA of the MACD line, known as the signal line. The MACD has two lines, the MACD line and the signal line. The interaction between these lines can provide valuable signals about the market's direction. When the MACD line crosses above the signal line, it can signal a bullish trend reversal. This crossover suggests that the stock's price is gaining upward momentum, and traders might consider this a buying opportunity. This means the price might be about to go up. Traders often look for this signal to enter long positions, anticipating that the stock will continue to rise. When the MACD line crosses below the signal line, it can signal a bearish trend reversal. This indicates that the stock's price is losing momentum and may start to decline. This means the price might be about to go down. Traders might use this signal to enter short positions, expecting the stock to decrease in value. The MACD also has a histogram, which is a series of bars that show the difference between the MACD line and the signal line. The histogram provides a visual representation of the momentum and can help traders gauge the strength of a trend. The histogram can help you gauge the strength of a trend reversal. When the bars are increasing in height, it indicates strengthening momentum, while decreasing bars suggest weakening momentum. By paying attention to these changes, traders can make more informed decisions about when to enter or exit trades. Section 9. Chart your course to stock market success. Congratulations! You've just taken your first steps into the world of technical analysis. Remember, this is just the beginning of your journey. The key to mastering technical analysis, like any skill, is practice, practice, practice. Start by practicing with paper trading. This allows you to test out your strategies without risking real money. As you gain confidence, you can start applying your knowledge to real-world trading. Remember, the stock market is always changing. Don't be afraid to adjust your strategies as you learn and gain more experience. Stay curious, keep learning, and never stop exploring. The world of investing awaits, and with the power of technical analysis, you're well on your way to charting your course to stock market success.